you ever asked yourself why fair value gaps don't work most of the time? The reason is that there's no obligation for price to respect them, and they encourage guessing instead of confirmation. But that doesn't necessarily mean that you shouldn't trade them at all when they get disrespected. In fact, this is exactly when you can confirm a high probability trade. And it's actually so simple that even a child could do it. I've been trading for over 6 years, and it took me 2 of those years to become profitable. And until I learned this one thing, I kept blowing accounts over and over again. Stick around, because by the end of this video, you'll know the exact concept that made me $16,000 in one trade, and you'll know exactly how I managed to make $15,000 every single month just by trading this one strategy. By the way, I can easily sell this information like most trading gurus do, but I know a lot of you out there are still just struggling to get your first payout, and that's why I'm giving you this information for free. So do me a favor and drop a sub on this channel. I go live every single day for Asia's session. If you want to join me, just hit that link in the description. First, let's go over a few things about fair value gaps. What is a fair value gap? It's a concept used in price action to describe an imbalance created by aggressive selling or buying. It's identified in a 3-candle pattern, creating a gap between the first and the third candle. The idea is that price moved too fast, or some sellers or buyers were left behind. So the market typically tends to come back into this area to rebalance the inefficiency of the buyers or sellers that were left in the area. So the market often comes back to retest that area, but it's not guaranteed. It's a context tool occasionally used with structure, liquidity, and timing. But even aligned with those concepts, they still tend to get disrespected and not give you a high probability trade. But if you look closely, when a fair value gap is broken, price comes back to retest that area as a resistance or support, and then tends to move in the opposite direction. We refer to this concept as an IFVG, or an inverted fair value gap. An inverted fair value gap is a disrespected fair value gap that can be used as a trend reversal or market structure shift as a high probability area that you can use for your entry. And it is so powerful that it helped me achieve around an 87% win rate in the last 4 years that I've been profitable. And if you master this strategy, I guarantee you will pull numbers like these every single month. When price invalidates the original fair value gap, it generally breaks key levels and redefines market context. That makes the IFVG not just a leftover zone, but a marker of structural shift, which means the market is changing direction. Institutions and smart money don't trade around small imbalances. They hunt liquidity. Liquidity pools usually sit beyond recent highs and lows, around stops or near prior zones of interest, and IFVGs form after price sweeps liquidity, continues past the gap, or leaves the gap behind and maintains direction. That means the market has already accumulated liquidity, invalidated the weaker side, or committed to the stronger side. This is the exact type of movement that professionals trade, but as most of them are valid, there are a few that you should reconsider before you take a trade. To find a valid IFVG, you must do these 3 things. The first one is order flow. Now, what is order flow? And it's a continuation model that tells us if the market is bullish or bearish, and if you want a high probability trade with the lowest risk possible, you need to understand order flow. And they're not even that complicated. Most of what you see on YouTube makes them seem way more confusing, using tools that just overwhelm you, and I'm gonna make it so simple for you. Order flow is identifying market structure by marking out the higher highs and higher lows for an uptrend, and the lower highs and lower lows for a downtrend. You can look at what direction the disrespected fair value gaps are leaning towards. Either it's constantly going to be respecting the bullish fair value gaps and disrespecting the bearish ones, or vice versa. You can use the rectangle tool to highlight those areas, but I personally like to use the horizontal ray because I don't want my chart to look like a mess. Now you know what order flow is. Let's talk about how to mark out the perfect IFVGs and which ones to avoid. Let's say you're in a bearish order flow, but you mark this IFVG. This IFVG isn't likely to be respected because if you look closely, it's bullish, while the market trend is clearly bearish. And trading against the trend is like trying to catch a falling knife, which I do not recommend. You wait for it to fall to the floor and then you pick it up. That's how you avoid getting any major cuts. This, on the other hand, is a perfect setup. This bullish FVG flipped into a bearish IFVG, which now lines up perfectly with the market's bearish order flow. But this doesn't mean you're ready to take a trade yet. You're gonna need to know the next 2 things that I'm about to mention. Have you ever taken a trade that hits your TP as soon as you enter? That feeling is rare. You'll feel like Andrew Tate for a few minutes. Most of you probably got lucky when you took trades like that, but what if I can tell you, you can take those trades every single day? All it takes is simply identifying this concept, and that concept is momentum. Momentum is an idea more than a concept that tells us whether price is moving slowly or aggressively. You can tell that so easily just by looking at the candles. If the price moves slowly with small candles, this indicates that there's no momentum in the market. But when price is pushing through aggressively with big candles, that's when momentum kicks in. But how do we use it for trading IFVGs? First, let's identify order flow. Then mark your IFVG that perfectly aligns with the structure of the market. If the price breaks through with small candles, you should avoid this trade at all costs. But if it breaks through with large aggressive candles, that's when you actually enter the trade. But we're not done yet. There's one more thing that you need to check before placing a trade. And that last thing is sessions. You know that trading in the wrong session is like fishing in a spot that has no fish? Timing is the most important thing when it comes to trading IFVGs. And each currency has its own session that gives it the most volatility during that session. So now I'm going to break down what pairs are best for each session and what session I personally trade. There are 3 sessions in the market: Asia session, London session, and New York session. Now, what are the best sessions? Well, it depends on the pair that you trade. If you're trading JPY or AUD pairs, the Asia session works best. I personally trade XAUUSD most of the time, and even though many traders tell you not to trade gold during Asia session, in my experience, it actually works really well with IFVGs. While those pairs are best for Asia, you should avoid trading pairs that are GBP, Euro, or USD only driven pairs like Euro USD, GBP USD, and USD CHF. These pairs are not related to JPY whatsoever, so they're not going to be volatile during Asia session. That's, as I described it, fishing in a spot that has no fish. You're just wasting your time. Let's see an example combining sessions with the previous concepts. This is a gold chart on the 15-minute time frame. You can see the market structure is forming higher highs and higher lows. Clearly indicates a bullish order flow with an FVG that needs to be broken. However, since we're not in the ideal session, there's a lack of momentum in the market. So placing a trade will be a risky move, and it's not going to work most of the time. This is another gold chart on the 15-minute time frame. The market is forming higher highs and higher lows, which means we're in a bullish order flow. You can see this bearish FVG that needs to be broken. Now we're in the Asia New York overlap session, which is the best time for momentum to kick in. The FVG gets broken and turns into an IFVG. Now we take the trade entry right at the IFVG, targeting the high, with stops being below the low, and from there, price pushes straight to the target. That's an easy banger. By the way, if you want to catch trades like these live with me every single day, click the first link to join my free Telegram community. And if you want to learn my full strategy blueprint, make sure to subscribe because I'll be dropping videos like this every single week. And if you want to know the best and worst trading concepts, in my next video, I'll be ranking the strongest strategies and the weakest ones. If you have any questions or you think I missed anything in this video, let me know in the comments, and I'll see you guys in the next video.